This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Thomas Lojko, summer intern at LightBox and guest moderator, here with co-hosts Dianne, Crocker, and Manus, Clancy. Welcome to this week's episode. Let's dive in with the news developments this week. Manus, what else besides Spain's World Cup do you want to talk about?
Thank you, Thomas, and welcome. Your debut for the LightBox podcast. Welcome, and it's been a pleasure having you in our New York office this week. Spain and all their followers are very happy this week after their 1-0 victory over Argentina. It was an exciting month here. I don't know how you feel, Dianne, but I thought it was terrific on so many levels for the United States. The cities, I think, put on a great face. There was no violence. There was no disorderly conduct. The fans seemed really happy. The venue seemed terrific. I thought it was a great kumbaya moment for mankind over the last month in the United States, and it contrasted quite dramatically with what we're seeing around the rest of the world.
Yeah, I agree. I got World Cup fever big time, so I have serious withdrawal. And, watching it, it was the same sense I had when the Olympics were going on. Just, everybody together, celebrating their unique cultures, fighting it out on the field. It was so fun watching the fans in the stands too. So I'm definitely going to miss it. And welcome, Thomas. It's so good to have you. And thanks for taking us up on our invitation to moderate. All right, Manus, no World Cup to talk about anymore, so let's dive into the news of the week. What are you thinking?
I think what we're seeing geopolitically is the polar opposite of what we got with the World Cup. Here in the United States, from Miami to Seattle to New York to Dallas, it was peace and harmony. Even if two heated rivals like France and Spain were playing each other, it didn't find its way into the stands or the streets. The people were happy. They were happy to cheer their teams on and enjoy the moment. And what we're seeing geopolitically is the exact opposite. It's exactly what we didn't want to see a month ago. If you recall, I was upbeat. I thought we have this memorandum of understanding. The peace is in place. We were hoping, keeping our fingers crossed, that it would hold. We were grateful that oil was under $70 a barrel, that we were starting to see better CPI and PPI prints. And yet, where are we today? We're back to $100 oil, the yield on the 10-year up to 4.66% just a couple of moments ago. Active fighting on both sides, the U.S. bombing the Iranian inland and the Iranians firing missiles at ships in the Strait. So it's hard to take a lot out of this week in terms of positives. Last week we had a couple. We had good manufacturing data. We had good inflation numbers. We had terrific bank earnings. This week it feels worse. Yields are up 15 basis points. The shooting seems to have picked up in the Middle East, and there doesn't seem to be any end in sight at the moment.
Agreed. I think the words no end in sight is really the operative phrase for markets right now. And the war in Iran is shaping pretty much every narrative. It pulled our oil prices back up. As you said, the 10-year went up above 4.6, which was its highest mark in weeks. And the hopes for a quick resolution are dwindling. And it's frustrating to say the least. And, it reminds me of when we talk like in early June, mid-June, and, we're telling people take your vacations now. We're like queuing up for a busier second half. And, now like the words no end in sight just make my heart sink, like thinking how much longer can this go on?
And I think it's not just how much longer can this go on. I think it's partly when does this break? We didn't see things break in April or May when we got to $120 oil and when the 10-year was up to close to 470, we soldiered on. But you can't soldier on forever. And now we're retracing some of those higher oil prices, certainly the higher bond yields right now. And you ask yourself, how long can the CRE market continue with the stiff upper lip? And that's what concerns me. What doesn't concern me is maybe people get two vacations, a vacation in June and another in October. Right, that's the silver lining. But we were really hoping for a robust second half in CRE driven by lower bond yields, by optimism that peace had broken out, by $65 oil. And right now, all of that is, if not just at risk, in severe doubt.
Mm-hmm. Right. And the CRE activity index for July, I think, will tell us some of that story at least. You might remember June's went down by just a little bit. So I think July will be very telling to see if we see another tick downward, whether it stays stable. I wouldn't bet that it would go up, but you never know. Sometimes it surprises us.
It will be interesting. I'm finding anecdotally with our deal tracker, we track deals really in real time. It's now in our LightBox Live product. You could see every 2 or 3 minutes new sales transactions taking place thanks to our really terrific team of people collecting data and building tools to surface the data, that it doesn't feel like there's been a material drop-off in the last 2 weeks. But then again, it's early. It's early in the end of the ceasefire. We're probably 2 weeks into it now. Maybe July will give us a hint. Maybe August will be a better indicator.
Yeah. And I mean, last week we were talking about big bank earnings coming in very, very strong. This week we had the Fed's Beige Book come out. So that basically broadly confirmed the stories that the lenders' earnings reports were telling. Beige Book showed the economy expanding modestly across 11 of the 12 districts, and CRE lending was picking up in some markets. I did notice there was a soft spot, and that was the Fed's reference to uneven development and refis. And, that to me is essentially Fed speak for a divided market, that some borrowers are refinancing successfully, others have to confront maturity walls at rates that were that are now well above what they originally overwrote. But all in all, the Beige Book was fairly positive.
Yeah, the higher rates are really a wet blanket for every corner of the U.S. economy. I think for homeowners, I think people were starting to think when we were down to that 430 level, maybe I'll be able to lock in that mortgage rate lower than I was anticipating. That is kind of shot out the window now. We're 30 or 40 basis points higher now. I thought, people were probably expecting on the CRE side maybe to finance their purchases or refinance with cheaper debt than they're seeing. That's really, again, out the window at this point. And I would also say that what we're starting to see is more and more, it's not just higher bond yields, it's higher risk premiums that we're starting to see. We didn't get this at all, or not a whole lot of it in the spring. Yes, we saw a week or two when bond spreads moved out. I think right now what we're seeing is something more material. And I do think it ties back to, and perhaps I mentioned this last week, there has been so much debt issuance by the Magnificent Seven, by the Googles and the Amazons of the world to finance data center buildouts and AI modeling, that they have flooded the market with debt. And anytime you flood the market with debt, you're basically adding more supply. You're adding more things that bond buyers have to choose from, and that makes bond yields go up, risk premiums go up. And we've seen that over the last couple of weeks. And it's not just limited to the corporate bond market or to the financing that is driving these data centers. There's a gravitational pull. When there's more offerings, there's more to choose from, and that pulls risk premiums wider across the entire fixed income spectrum.
Mm-hmm. It's true. And certainly more questions are being raised about the payoff for that investment. Will it pay off? Is it getting too frothy? Is there too much construction? But at the same time, it's still like plowing forward. Did you see, Manus, that New York just became the first state to pass a moratorium on data center construction to give the state time to write energy and environmental rules? And
they won't be the last. There'll be some states that embrace this and other states that don't. It was the same way with fracking, so that should come as no surprise. So I do think that there'll be resistance in many areas, and I think the unknowns justify some of the resistance. Until you get assurances that the energy burden is going to be borne by these Mag 7 companies, it's hard to sleep at night, I would say. Like, I want to know if a data center is going to come 10 miles away from my home, I want to know that it's not going to double my utility costs. So I think that there's a lot to this until some of this gets revealed and plays out.
Or if you have a heat wave in South Carolina and you can't use your AC because it's all going to the data center.
My goodness, imagine. I think you'd see people out with pitchforks and torches at that point. Right? That would be a problem. I guess every constituent has their angle, right? If you can't get heat in the winter in the Northeast, if you can't get your air conditioning in the Southwest, if you can't get your gaming, right? If you're getting loose connections on your gaming at night, right? Because, the energy and the grid is taking down your computer. What do you think, Thomas? Are you a gamer?
I really like playing NBA 2K and Madden.
There you go. So you have to keep your eye on this. You don't want the grid disrupted. You want to be able to play your 2026 NBA 2K or your Madden, right? That you gotta, even though you're young, you gotta look at these things early on.
Yeah, I can't let my friends beat me. I need the best internet.
There you go. There was one big deal this week, Dianne, we should talk about. This was LXP Industrial being acquired this week, and this was no small sale. This came out a couple days ago. Brookfield and the Canadian Pension Fund ponying up $5.2 billion in a cash deal that will allow them to acquire the industrial REIT. That includes the debt and preferred equity, and it's just evidence that this industrial rally that started 11 or 12 years ago still has legs. It's the rally that never ends.
Yeah, true. I mean, that dollar amount is definitely one to raise eyebrows, and they're making a long-term bet on decades-long cash flow. I kind of read it as a vote that they think industrial and logistics real estate fundamentals, things like e-commerce distribution, reshoring is a huge tailwind there, data center adjacent demand. They're thinking as those are all strong enough to clear the high cost of capital hurdle right now. So
Brookfield and the pension fund, if I remember correctly, paying a 12% premium over the REIT's price prior to the announcement. So they are paying a hefty premium for this. But it's interesting with the industrial because there were times over the last 24 months that headlines came out that the trade was getting tired. In South Florida, a leveling off of industrial rents. In the Inland Empire in Southern California, the same thing, that the rent growth that people had been accustomed to starting to level off. That narrative seems to be dissipating a little bit. It seems that was a brief timeout in what has otherwise been a rally that started in 2015.
Mm-hmm. Very true. Very true. And there's a lot happening in industrial just in terms of supply imbalances coming out of the construction highs of the past few years. And I think it's a good example of a market where location's important because it's very differentiated. One metro could have a very strong industrial market and others could still be struggling with too much supply.
That has certainly been the winning recipe over the last decade or so. If you were somebody smart enough to pick up industrial hand over fist when it was trading for $40 or $50 or $60 a square foot, a hat tip to you. You really probably six-bagged that particular trade because these things are now $200 or $300, if not more, per square foot. Let's take a quick pivot. I know, Dianne, you and Thomas were out at a geospatial conference. I hear it's the Super Bowl of conferences. Upwards of 15 or 20,000 people go to San Diego to learn all there is to learn about geospatial. Let me turn this over to you and hear what you had to learn in Southern California over the last week or two.
Well, I'll say, Manus, I did not go. I love San Diego, so I had a little bit of FOMO, but we did have a strong LightBox team. It's the Esri User Conference in San Diego. So for any listeners who may not be familiar with Esri, it's one of the leading GIS technology companies. GIS is Geographic Information Systems, and it's the technology that pretty much layers location-based data. So things like parcels, infrastructure, demographics, even environmental conditions, and they layer them onto maps. So it's like a visual tool that helps people see patterns and relationships that they're not going to get from staring at an Excel spreadsheet. So Thomas, Manus is right. I heard there were 18,000 people there, which is like a small town. And you, as our summer intern, got to go to a really fabulous city for it. So I'm wondering what your thoughts were.
Yes, I was able to be there on the floor and it was super exciting. I was surprised there were so many people with the World Cup being on simultaneously, but it was my first conference, and when talking to people on the floor, there was a lot of common things I would see, as in when talking about the future of GIS, there was whether it was positive, negative, excited, nervous, the conversation was AI and how to manage that and the sustainability of it, but also is it going to take away jobs? So that was a very interesting conversation to have with people who were experts in the field.
Very cool. AI can get anybody talking is what I'm finding. Everybody has an opinion about AI, good or bad, and it sounds like you heard the same.
Yes, I heard all of it.
It's interesting. I know we have a really wide swath of listeners by persona on this podcast. We have everybody from lenders to appraisers, to bond traders, portfolio managers, property owners. But we also have an entire category of people that serve this market, environmental engineers, people that have to do surveys, phase ones, phase twos, look at what was at a property historically. And it's interesting for me, and I'm going to say something that's very honest, and that is, having come from the capital markets before I was at LightBox, I had no idea just how the machinery and how deep the thinking is behind all the work that goes into making sure that the soil is clean, that there isn't a nearby dry cleaner who's spewing chemicals into the groundwater, that there wasn't a gas station 30 years ago at this location. In the capital markets, this is kind of left to the smart people, right? It's, you want to come back, you get your phase one, you get your surveys, you get all this data back. When you come to LightBox and you start using these tools, you really get a taste of the real art and science that goes into helping people make these decisions and avoid risk.
It's true. It's no joke. I mean, if there's a dry cleaner on your property or used to be, or a leaking underground storage tank, the cost to clean up, the liability could easily wipe out any ROI that you were hoping to get on a property. And now with data out there that's readily available, I mean, there's really no reason not to look and find out ahead of time so that you can go into a deal with your eyes wide open.
For those that are kind of tourists in this space, I've mentioned this maybe a month or two ago, but the folks at LightBox actually went back and digitized city directories from around the country going back to the 1800s. So they can actually tell you, was there ever a munitions plant in this location? Was there ever a storage tank underground? Who was the tenant here? Was it a gas station? Was it a dry cleaner? Just an incredible uplift, if you will, in the profession and what people can look at and understand before they actually write a check. And I think, to Thomas's point, I think AI puts this on steroids. I think that we've only scratched the surface of what people can know that in the past was either unknowable or just too hard to learn.
Or it took too long, to look at these mountains of data records. And now AI can review things so much more quickly, as long as the data that you're giving it to work with is good data.
An incredible lift by the LightBox team here. Well, it sounds great. It sounds like a great conference. I'm always blown away when I look at the geospatial stuff, when you could see all the points of interest and the demographics and the geography over time, where you could actually see the time series of how did this area look in 1990 versus 2000 versus 2010, the building footprints, the shapes, the sizes, the centroids that go into it. It's all really something that blows me away when you start playing with it.
Mm-hmm. Thomas, I hope that you got a sticker from the LightBox booth that said Map Nerd on it.
I left my bag at a restaurant on my way out, so I lost all my swag.
Oh no, that is a rookie mistake.
Yeah, rookie mistake.
There'll be other conferences for sure. And what you learn when you get to my age is you've collected an awful lot of swag over the years.
Let's move to the data dive. What do you have for us this week, Dianne?
Thanks, Thomas. So yesterday I gave a mid-year market update on commercial real estate lending at the Environmental Bankers Association summer conference. I will say, Thomas, there were not 18,000 people, more like 300 or so, but I did a live poll during my track, so I'll pull from that for the data dive. Talking about 300 environmental risk managers and the due diligence consultants, Manus, that you were just talking about, who support bank lending across the U.S. And the question was, on a scale from 1 worsening to 100 improving, how would you characterize the CRE lending environment at mid-year? And 51% came in with a score of 40 to 60, which was labeled as more or less the same as the first half. And another 32% came in at an even stronger 60 to 80. So that's 84% in pretty positive territory. So sounds like the attendees are feeling pretty good about things.
Those are great numbers. And even if they were to say things are going to stay the same in the second half, the first half was okay. We saw a decent uptick in transactions. We saw a decent uptick in economic velocity from the end of last year through about June of this year. So if they were to say neutral, I think neutral would be a positive sign in light of all the volatility we've seen over the last 3 or 4 months. The fact that it was better than neutral, I think, is a positive sign.
That's why I'm feeling pretty good about it. And I wanted to add to that, too, that CREFC, the CRE Finance Council, they came out with their latest quarterly survey, and it showed something similar. And they did this, I believe it was early July, and it showed that industry leaders appeared to have moved behind the shock, which came through in their Q1 survey. The reason I say that is that the share of responses who had a negative 12-month outlook fell from 22% in Q1 to only 8% now. And most of that movement, Manus, went into the neutral camp, not the positive one. So I think it kind of points to a lending community that's stabilizing. They're adapting to the current state of affairs. They're staying disciplined and cautious. So that's a good thing. It's a healthy development, but I think nobody's overly optimistic given everything else that's going on the geopolitical front.
So let me throw you a curveball here. Now that you've given us these two surveys here, what for you and what for the industry do you think changes what is generally an outlook from people that's pretty positive? You can answer this either as yourself or putting yourself in the shoes of the people you talk to on a daily basis. But what do you think is the thing that would move that needle south in terms of optimism, stability, etc.?
Normally, I would say that the war lingers, but it's already lingering, and that doesn't seem to affect their optimism. I think maybe if something happened in the equities market that really kind of, to go back to the Jenga analogy of a few weeks ago, that really kind of shook the foundation of the equities market, that would probably ripple through and make folks feel a lot more skittish and a lot more pessimistic.
If I were to choose two, I would choose these. I would say there is a number at which people get really nervous. We haven't hit it yet. We've hit a 470 10-year at some point in the last couple months. So we know it's not 470. Is it 475? Is it 485? Is it 5? Is it 5.25? I don't know. But there is a number out there where I think the market heads for the hills. So I do think that that's one area where people would change their outlook at a certain point. But I do think that the other side of this, I do think, going back to my remarks from about 10 minutes ago, I do think that there's a bond market inflection. If people say, we need to borrow another $1.5 trillion, we need to tap the capital markets, and people start to get really cold feet about lending more money to data centers or more money for AI buildouts, and the market kind of turtles a little bit, I think that would be kind of a concerning point. You'd see risk premiums blow out, and I think that if that volatility were to kind of rear its ugly head, I think that people might get conservative very quickly.
Mm-hmm. Yeah. And it's, it only takes one or two to kind of tap the brakes, and then everybody else taps the brakes too.
Right. This is a herd-like industry. If people start thinking that risk premiums are going wider and they're better off kind of holding on to their cash, not deploying capital, that's a scary premise.
How about this week's Did You Know, Dianne? What do you got for us?
Well, Thomas, I have data centers on the brain. We already talked about the moratorium in New York. I was in Indianapolis last week visiting one of our clients who does a lot of environmental due diligence in the data center space. And Manus, I used the transaction tracker database that your folks work so hard on and calculated that in the past 18 months, we have logged a total of $47 billion in transactions of either industrial parcels or raw land that's targeted for data center construction, mostly in Virginia and Ohio. So based on the moratorium in New York and the likelihood that other states will follow, it'll be interesting to see if there's any kind of geographic shift in where these transactions are taking place.
I think we've seen some as well in Southern Illinois and in Arizona, here and there, not the numbers that you're talking about like we've seen in Virginia. Virginia is the epicenter of data center delivery, but that's an enormous amount of development and spend. And you made reference to this before. I think it's really hard to know if these data centers ever recoup their investment. There's a lot of what ifs here. For one thing, the turnover in chips that people have to buy to support AI is a really short window. Guys like AMD and NVIDIA and others are pouring out new chips. So these data centers are going to have to be refurbished very frequently, which will add to the cost. We know that the energy is going to be incredibly expensive, and we don't know who's going to win this race. When we did search, as you know, Dianne, that in the beginning there was Yahoo and there was Bing and there was Google. There's probably some others that I'm forgetting, but there was a clear winner out of that. Google won. They got whatever the number is, 95% market share. Their stock price skyrocketed. They've been monetizing this ever since. And Yahoo and Bing kind of fell by the wayside. And there's a very high likelihood that there is one winner out of this, or two winners, whether it's Claude or OpenAI or Chat, whomever, or maybe one of the Chinese operators, I don't know. But it's an awful lot of money to spend really on spec. You don't know if you're going to win this race. And these firms are eating up really all of their free cash flow for the next couple of years in pursuit of this holy grail.
Yep, agreed. And I wonder, like, long-term, what happens to these gigantic data centers 10, 20 years from now? At any point, do they become obsolete? And then what happens? And as you mentioned, Yahoo and Bing, it just made me think of Thomas, who's in college now, and he'll never get that sensation of like a dial-up connection and that annoying noise that it used to make while you waited for that connection to happen.
We could spend a whole afternoon talking about watching a TV wait to warm up, or television going off at 12:30 with the national anthem, reading the TV guide to figure out what was going to be on TV. We ready for some deal news, Dianne?
I think so. Jump in. What do you have for us?
Let's start with multifamily. We haven't talked about multifamily in a while. We've seen several sizable deals here. One in Rogers, Arkansas. We don't talk about Arkansas a whole lot. There, Widener paid $63 million for the ranch at Pinnacle Point. Here, that purchase price equates to about $160K per unit. The property last sold for under $50 million in January of 2019. Reporting there by Jeff Della Russa of the Northwest Arkansas Business Journal. We've talked about this a lot, Dianne, winners and losers in the apartment space. That here we have a winner. The Widener guys paying a premium of about a third over what this thing sold for 6 years ago. I don't think Rogers, Arkansas, maybe I'm wrong, was one of those markets that really ran up like Charlotte or Phoenix, Scottsdale, Tucson, Southeast, Southwest Florida during the COVID years. So here what you have is a stable market taking the benefit of surging rents over the last 5 or 6 years and monetizing this to the tune of a 33% premium over the last sale. Another one here in Washington, this is in Arlington, Berkshire Residential paying more than $200 million for Central Place residences. This is a 31-story apartment tower in the DC suburb here. So another example of a really sizable multifamily sale taking place even as interest rates have been moving higher.
Yeah, I want to talk about the Arkansas deal a little bit because we don't talk about that area of the country much at all. We talk a lot about Sunbelt metros, as you said, Dallas, Charlotte, Atlanta. And Northwest Arkansas doesn't get much mention. I know somebody who works in Fayetteville, and I was really surprised to hear that it's got a strong corporate employment base. She said you've got headquarters there for companies like Walmart, Tyson Foods, JB Hunt. So here's a deal where they're moving into kind of an unsung market, but one with strong population and corporate employment. And I read that property is only 30% renovated. So there's an opportunity for a nice value add in a hot market. So the thing that struck me about the deal that you mentioned in Northern Virginia is, it's proof that a modern apartment tower across the river from Georgetown with great views can command more than $500,000 per unit. It's near a metro, so I'm sure that makes it appealing. I lived in that area right after college. I was not in a luxury high-rise, but it was definitely a great walkable area and a fun place to live.
This was another thing, Thomas, about those days. You usually shared a bedroom even after college, right? You'd have a 2-bedroom apartment with four people splitting the rent back then. You guys don't know how easy you have it now. Dianne, you mentioned Charlotte briefly. I did want to throw one in there. This is in the office category, and I know we have another office story to talk about. This story from Elise Franco of the Charlotte Business Journal. She's reporting that Heinz Global paid $170 million for a South End Charlotte property from 1515 Camden Road to about 1930 Camden Road. This is 240,000 square feet of retail creative office. So that got my attention because it goes back to the narrative we've had since the beginning of the year that there's office and there's office. If you have old office, Class B or Class C, no amenities, nothing creative about it, tired, you're going to struggle. You're selling your thing at 75% off. You're in the discount bin. But here you have Hines paying nearly $200 million for what sounds like a really cool place to go to work, right? Creative office, mixed use. I'm sure there's plenty of retail, restaurants, after work places there. And it shows the dichotomy of where office is today.
Yeah, creative office kind of gets at the heart of what we've been talking about. In order for your property to be appealing, it's got to have some kind of amenities, like a pickleball court or barbershop or a food hall in the main floor, places for people to gather and connect.
It's funny. You talk about amenities. For me, pickleball's not an amenity. I might take some flack for that one. I know that there's people that love pickleball more than they love their family or more than they love their household pet. I'm not in that camp. So using that as amenity to lure me in, I'm out. On the other hand, a nice sleep room, maybe a nice bar and grill in the lobby, a roof deck. I could live with those. Pickleball, not so much. I want to pivot to a second one. This is a guy I've been following for a really long time. He's a really terrific resource in the Pittsburgh area. Tim Schooley of the Pittsburgh Business Times. He was reporting this week that it appears that two big Pittsburgh offices are on the cusp of selling. I think there's more wood to cut here for these deals to get over the finish line. And I'm certainly not talking out of school. This was in the Pittsburgh Business Times publication. But his story is that CSB Holdings, this is Chesky Brock's firm, is looking to buy or close to buying. The two properties that they are looking at are EQT Plaza, that's also known as 625 Liberty, 32 stories, 600,000 square feet. That is one of the properties being circled by CSB. The other is the McCandless Corporate Center. That's a suburban office park on McKnight Road in the Pittsburgh MSA, 300,000 square feet there. That would be a nice lift if they were to come in here and try to improve on these offices, buy them at a discount, try to re-tenant them, maybe add some amenities. Pittsburgh has not been immune to some of the problems that we've seen in other cities. Declining values, tenants taking up smaller spaces or moving to the suburbs. Let's hope this goes through and let's hope this leads to a revitalization in Pittsburgh.
Yeah, Pittsburgh's a great town. And I feel like this is the second or third major downtown Pittsburgh office tower that's like trophy-ish that we saw change hands this way, and this one was interesting because it's a pair of one's a downtown deep discount kind of trade and the other sounds like it's a suburban office park. So maybe it's a play of like buying distressed office enough to make the economics work across a platform rather than betting on a single asset's turnaround.
That's right. And I like Pittsburgh. I like that what was done with the new stadiums. Downtown. That baseball stadium is really terrific. One of my favorites out there. And a more vitalized downtown, I think, would do wonders for that city. They benefited to some degree during the tech run-up by their proximity to Carnegie Mellon. And I know Carnegie Mellon has great talent. I'm sure they have great AI talent there. Maybe that's part of the play here. We'll have to see. I want to run through a couple of development stories and then we'll call it a day on the news items. Why do I bring these up every week, development? I bring them up because they are usually a combination of people putting shovels in the ground or people announcing plans to convert resi to office. If I were a listener to my own podcast, which I'm not, that would be weird. But if I were a listener and I didn't hear stories like this, that would be the canary in the coal mine. If there wasn't stories every week of people putting shovels in the ground or lining up financings for construction, I would say this is a market that is starting to lose some of its liquidity and some of its confidence. Yet here we are week after week coming up with more stories than you can imagine in this category. So without further ado, here we go. Greenberg Gibbons in Frederick, Maryland. They're breaking ground on what will be a $450 million mixed-use project. This is about 50 miles northwest of Baltimore. When it's done, this will be a 65-acre project, reporting there by Real Estate Business Online. In Asbury Park, New Jersey. This is where Bruce Springsteen cut his teeth at the Stone Pony back in the day. Madison Realty Capital and Cottonwood have made a $200 million construction loan to Somerset Development. Somerset will be building Lido Asbury Park, which is expected to finish in 2028. This one kind of noteworthy because Asbury Park kind of left for dead about a decade ago. A lot of crime, not a lot of people living there. It was an area of blight in what was otherwise a really nice area of the Jersey Shore. And here we see Somerset Development looking to put up what seems to be a high-end luxury apartments in that area. So good on Asbury Park and their comeback. In downtown Miami, Witkoff and Monroe Capital, they got a $300 million construction loan from Athene, which is Apollo's lending arm, and JP Morgan to finance that development. And in Chicago, Onair snagged a $9 million property, or they paid $9 million for a property at 70 East Lake, which they are going to convert to 170 units in downtown Chicago. So pretty good geographic diversity there. A lot going on, a lot of shovels going in the ground, a lot of lending taking place, and a lot of planning on conversions. So for that, we can all be very grateful.
Indeed. And we started the podcast maybe on a bit of a pessimistic note. So I love that you brought it full circle with some encouraging stories of, as you say, putting shovels in the ground. For this week's Slice of Life, I read that Wall Street may be putting more for sale signs in front yards. Diana Olick at CNBC reported that the number of institutionally owned homes listed for sale has more than doubled since early February. And that's the result of the new federal housing legislation that's preventing investors who own at least 350 homes from buying more, which got me thinking that even if institutional investors release more homes onto the market, we're still dealing with high home prices. We're still dealing with mortgage rates that are pretty big hurdles for first-time buyers. And NAR says the typical first-time buyer is now 40 years old compared to the late 20s and the 80s. So, Manus, that's a long intro to my slice of life question, which is, how old were you when you bought your first home?
I was 31. I already had 2 kids. I had still yet to buy a car. If you can imagine, I had 2 kids, bought a house and bought a car after that because I was living in an apartment where I could walk to a train station every day. My wife had a car. So I was 31, and I'll never forget, 3 days after the close, we had a historic snowstorm that left 30 inches of snow in our neighborhood. And we had an outdoor porch, and it was piling up on the roof of our porch. And I had no idea, like, could this collapse the porch? So I was out there shoveling the roof of the porch because I didn't know any better. I didn't know if the house could sustain this or not. Things you learn when you buy your first home.
Wow, that's so funny. I was a little older. I was closer to this year's average, but I was 39. And I will say it was right before the big market crash. So word of warning, don't ever take investment advice from me.
So Thomas, we have to ask you, because I'm a boomer and Dianne is not a boomer, but she is older than you. And that's all I'll say about that. But what are people from your generation talking about when it comes to, or thinking about when it comes to owning homes in the future? We hear stories about the upcoming generation doesn't see themselves as part of a generation that needs a home, that wants a backyard. You will raise your family in multifamily housing or an apartment. Is this a generational change? Is this how you're thinking about things? Or is it NBA 2K and nothing else?
Yeah, there's definitely a generational difference. When we do talk about eventually buying a home and getting a full-time job, that stuff is seen as very difficult, and we don't really feel the wealth trickling down, as one might say. Hopefully, as we get older, the market will get better, but as of right now, I would be concerned about finding a place to live.
I don't know how you feel about this, but when older people or people my age grew up, the things like mowing your own lawn, shoveling your own driveway were handed down from generation to generation. I don't see my boys, who are not much older than you, ever operating a shovel or operating a lawnmower. And I think that will define where they ultimately live. I think they're going to say, I want to live in a place where this is taken care of for me and that I never have to strain my back. How does that sound?
Honestly, living in the city, I've never had to mow a lawn before. I rarely shovel. I think the last time I shoveled was actually being a student athlete at my school. I had to shovel out the track for a workout. But yeah, I think for me personally, I would ideally want to live in a city. So I guess not having to do those things. But I have friends who want to live in rural areas. So I think it just varies from person to person.
Thomas, does that mean that you don't have a driver's license?
I do not. But yeah, hopefully soon.
That's great.
That seems like a good place to wrap up. Thank you to our producers at Brewing Media. Be sure to join us next week as we drill down into the news headlines, deals, and developments of the week. You can listen on all your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great weekend.
Let's go.